Charge going up, fire in the hole. Go. 1. Left clear, servers on the right, main floor clear, moving deeper.
Room secure.
Left. Multiple terminals, all live. Drives in, pulling the data now. Package secured, moving out.
In this final lesson, we're going to bring everything together. So how to build a complete trading strategy and integrate it with risk management so you can trade with confidence, consistency, and control. Everything we've covered up to this point, structure, candles, support and resistance, supply and demand, indicators, psychology, and platforms are all individual pieces. This is where they connect into one system that you can execute every day. Let's start with what a strategy actually is. A trading strategy is simply a repeatable process for identifying, entering, and managing trades. It removes emotion and replaces it with structure. The goal isn't to predict, it's to respond consistently to what the market shows you. Every strong strategy has 5 parts. Market bias, determining whether you'll look for buys, sells, or sit out. Setup conditions, what must happen before you consider entering. Entry triggers, the exact technical confirmation to pull the trigger. Risk management, how much you'll risk, where your stop loss goes, and where you'll take profit. Trade management, how you'll manage open trades, scaling out, moving stops, or exiting early if conditions change. Let's break each of these down. Step 1, market bias. Use higher time frames, like the daily or 4-hour, to determine overall direction. Are we trending up, trending down, or consolidating? If the daily chart shows higher highs and higher lows, your bias should be long. If it shows lower highs and lower lows, your bias should be short. No bias, stay neutral until structure forms. Step 2, setup conditions. This is where you define your trading edge. For example, your setup might be a pullback into a demand zone in an uptrend or a retest of broken support in a downtrend. You're identifying areas where probability is in your favor. Your goal isn't to find trades everywhere. It's to wait for your setup to appear, then act decisively. Step 3, entry triggers. This is where timing comes in. Use candlestick confirmations, breakouts, or indicator signals to trigger entry. For instance, a bullish engulfing candle forming inside a demand zone could be your trigger to go long, or a break and retest of a trend line with increasing volume might confirm momentum. Be specific. Your trigger should be clear enough that you could teach it to someone else and they'd see the same thing you do. Step 4, risk management. This is the backbone of your strategy. Define your stop loss before you enter, usually behind a recent swing, high or low. Then calculate your risk in dollars using the tick value of your contract. If you risk $200 per trade, don't increase it just because you feel confident. Keep it consistent. Always aim for a minimum 1 to 2 risk to reward ratio. Risk $200 to make $400. That ensures your winners pay for your losers and still leave profit. Also decide how you'll handle multiple contracts. Some traders scale out, taking partial profits at one level and letting the rest run with a trailing stop. Others close everything at once. The key is consistency. Step 5, trade management. Once you're in a trade, your job isn't over. It shifts to managing emotions and following the plan. If price moves halfway to your target, consider moving your stop to break even. If it hits your target, take the win and reset. Never move your stop further away, hoping price will turn around. That's emotion taking control. Over time, you'll learn that trading isn't about catching every move. It's about executing your plan with discipline. Let's talk about how risk management ties into this. Your account size determines your position size. If you're risking 1 to 2% per trade, you can survive dozens of losing trades in a row and still have capital to recover. That's how professionals stay in business. We move by managing downside first. Always remember, your goal isn't to make money fast, it's to not lose it fast. Consistency compounds. Before each session, review 3 things. What's the overall market direction? Where are my key zones or levels? What's my maximum risk today? Those 3 questions keep you grounded and prevent impulsive decisions. As you build experience, your strategy will evolve. You'll refine entries, optimize risk, and learn when to step away. But the core principles never change. Structure, risk control, and discipline. Remember, trading is a marathon, not a sprint. Every trade you take, win or lose, is data, information that shapes your future decisions. Keep journaling, stay patient, and trust the process. You now have the complete foundation from understanding market mechanics to reading structure, managing risk, and building your own strategy. This is the starting point of mastery. So take what you've learned, trade responsibly, and remember the rule we live by. Here at Breach and Clear Trading, precision beats prediction every single time.